You've been there. You do your research, you pick a stock, you buy in, and the second you buy, it tanks. So you hold, because it has to come back, right? It doesn't. You panic, you sell, and the moment you sell, it starts going back up, just like TJR.
Come on, dude. Let's not do this right now. Let's not do this right now, bro. Oh, dog. Oh. I lost $234,060.
That's not bad luck. That's the pattern almost every trader falls into. And it's exactly the pattern one man cracked completely, turning $1,600 into $350 million. His name was Richard Dennis. And his strategy? So simple it sounds fake, but the results are real, documented, and you can apply them right now. Here are the exact rules he used and taught to do it. Who is Richard Dennis? Richard Dennis started with $1,600 borrowed from his family. He took that money to the commodity trading floors of Chicago, and using a strict set of rules, he turned it into $350 million. Here's where it gets interesting. In 1983, he made a bet with his partner, William Eckhart, that he could take random people off the street, teach them his exact system in 2 weeks, and they would produce the same results. His partner said it was impossible. You can't teach someone to trade like that. Dennis proved him wrong. Those students, called the Turtles traders, went on to make $175 million using the rules you're about to hear. The turtle trading rules. Rule 1, trade the trend, not your opinion. Most traders lose money because they trade what they think will happen. Dennis didn't care what he thought. He only cared about what the market was actually doing. If the price was going up, he bought. If it was going down, he shortened. That's it. No predictions, no gut feelings, no news headlines. The trend is the signal. Everything else is noise. Just like this. Rule 2, buy breakouts, sell breakdowns. Dennis didn't buy when the stock was cheap. He bought when it broke above its highest price in the last 20 days. Why? Because a breakout above a recent high is the market signaling that buyers have taken control. He called this the System 1 entry. If the price broke above 20 days, enter. If it broke above 55 days, that was an even stronger signal. Same logic in reverse for shorting. If price broke below a recent low, that was a sell signal. Now here this guy is someone who really understands this.
This is one of the most unique trading strategies that you'll ever see on TradingView. Go to the indicators and search for trend lines with breaks and make sure that it's this one by Lux Algo. Go to the settings and just make sure to enable the show only confirmed breakouts. Then you're going to want to add the RSI or the relative strength index, and then finally add the trauma indicator. So here's the strategy. For a buy signal, wait for price to be above the trauma or the red line. Then you're gonna enter once you see a trendline breakout signal. Then you're gonna wait to exit the position until the RSI becomes overbought or above the 70 line. For a sell signal, just wait for price to be below the trauma and then wait for a red trendline break signal and exit once the RSI is oversold.
And you can see the profit coming easily. This rule is the core of everything. Give it room to breathe. Don't rush past it. Rule 3, risk exactly 1% per trade, no more. This is where most people get it wrong. They risk too much on one trade, it goes bad, and they blow up. Dennis's turtles were taught to never risk more than 1% of their total account on any single trade. On a $10,000 account, that's $100 at risk. That's it. This keeps you alive even through a losing streak, and every trader, even the best, goes through losing streaks.
I'm going to run through an example here on calculating your lot size based on the risk you want to use. So let's say we want to use 1% risk per trade, and our account size is $1,000. Our risk is essentially going to be $10 per trade when broken down. So step one, what you want to do is determine your stop loss in pips. So based on where you would normally place your stop loss, below structure, whatever. Example, let's say that's 50 pips, okay? You're going to use a lot size calculator, and we're going to determine the lot size to use. In this example, for using a 50 pip stop loss, that would give us a 0.02.
Rule 4, use a TR to size your position. Dennis calculated how volatile a market was using something called average true range, ATR. The more volatile the market, the smaller his position size. The more stable the market, the larger. Why? Because a volatile market can wipe out a big position in hours. By adjusting size to match volatility, he kept his actual dollar risk constant at that 1% rule no matter what market he was in. This is what separated him from gamblers. He was always in control of his exposure, but this is a clear example of how to do it.
So what's the ATR and how can we use it as a technical trader? The ATR is an indicator that measures the average volatility of a chart over a certain period of time. This can be useful for planning out trades since you get a feeling of how much the market is likely to move on average. The length is commonly set to 14, which is measuring the average volatility of the past 14 bars, and this can change depending on the time frames that we're looking at. So if we look at EURUSD's daily chart and we convert the current ATR's value to pips, this means that the past couple of daily candles on average each moved around 50 pips or so. So if we check another pair like Pound Aussie, we can see that the ATR value is basically double compared to EURUSD's. So for example, if we wanted to swing trade both pairs, then we know that we're going to need a much greater stop loss for Pound Aussie, since on average it moves a lot more. This is where some traders might set their stop loss 1 ATR value away from the entry price, or to be safer 1.5 times the ATR. But keep in mind that this depends on your entry, so be sure to combine this with the price action as well and backtest it.
Rule 5, cut losses at 2 ATR. No exceptions. Every trade had a predetermined exit if it went wrong. If the market moved 2 ATR units against his position, he was out. No waiting, no hope, no second opinions. Out. This sounds brutal, but this rule is what kept losing trades small. The turtles who struggled were the ones who broke this rule, who held on just a little longer. The ones who followed it exactly, they survived long enough to catch the big trends. Rule 6. Let winners run. Do not exit early. This is the rule that made the real money. Dennis didn't take profit when the trade was up 10% or 20 or even 50. He stayed in the trade as long as the trend continued. His exit signal was the opposite of his entry. If prices broke back below the 10-day low, that was the signal to exit, just like this guy is doing here.
Now, I'm losing really small and making really big. Boom. That is the secret of trading, okay? The secret of trading is letting your winners run. I was just about to say letting your losers run. Let your winners run and cut your losses.
Only then. Most traders kill their winners early because it feels good to lock in profit. Dennis knew the massive trends. The ones that turn thousands into millions only pay if you stay in them. Rule 7, trade multiple markets. Never concentrate. Dennis and his turtles traded across commodities, currencies, bonds, and metals simultaneously. Not because they were greedy, but because trends don't appear in every market at the same time. By spreading across many markets, they increased the chances of being in the right place when a major trend formed. One winning trend in soybeans could pay for 20 small losses across other markets. Diversification wasn't just safety, it was a mathematical requirement of the system. The results. The students who followed these rules exactly, the ones who didn't break Rule 5, didn't exit early, didn't override the system, produced $175 million in 5 years. The ones who broke the rules, they lost. Not because the system failed, because they stopped following it. That's the brutal truth Dennis kept repeating. The rules are simple. Following them when everything feels wrong, that's the hard part. He said it himself. You could publish these rules in a newspaper, and most people still wouldn't be able to use them. Not because they're complicated, because human emotion makes discipline feel impossible. 7 rules. That's the entire system. No secret algorithm, no insider information, no special background required. Trade the trend, buy breakouts, risk 1%, size by volatility, cut losses hard, let winners run, diversify across markets. The man who built this system turned $1,600 into $350 million. The people he taught went on to run some of the most successful trading funds on earth. The system is public. The rules are free. The question is whether you can actually follow them when the market feels like it's eating you alive. If this video helped you, subscribe. We're covering more stories like this, where one strategy changed everything. See you in the next one.